Interest capitalization is a fancy word for when your accrued interest gets added into your principal balance and that generates interest on interest. So, as an example, currently what happens is you go to school, you borrow in school, and the interest accrues during school. And when you come out of school, that interest gets added into the principal balance no matter what you do. It gets added in if you consolidate, it gets added in if you enter repayment, and you also compound your interest if you enter or exit a forbearance, basically. Generally, when you exit a forbearance, when you change repayment plans, all of those things capitalize your interest. And this is one of the reasons why you see these news stories sometimes of people that are just beside themselves because they're like, I paid 50,000 of my loans and I borrowed 30,000. Somehow I owe 90. So the only way that's possible really is if somebody is constantly in and out of forbearance, because every time you do that, it compounds your loans. And people generally don't understand that. And generally, people that can't afford to pay down their principal balance have to be making small payments that are not fully covering their interest. And so when you're not doing that and you're compounding your loans, it's going to grow exponentially on you. And that's something that shouldn't be the case maybe, but it's what happens. And it's people don't understand how is this possible. Well, that's how it's possible, is when you're in and out of forbearance or in and out of repayment plans and you're changing things constantly because you're struggling to make your payments and maybe you don't have access to information or you're not aware you can sign up for an income-based option. That's going to compound your balance. So this is going to take away the worst compounding, which is a good thing. And keep in mind, all these rules are proposed rules. They're not final until they've had the public comment period, but presumably they're not going to change. So what does that mean exactly? Well, your balance that you borrow is effectively what's going to be generating the interest, which is something that long term will cut your effective rate of interest. So how does this impact, if you decide to pay off your loans, how does that impact things? Well, it really does impact things if you think about it. So let's say you borrow 400,000 from dental school, and let's say you're borrowing at a 7% interest rate. So let's say that you graduate and you have 100,000 of accrued interest on 400,000 of loan principal. So your 7% interest is being charged on 400. Normally when that 100K gets added to your principal balance, now it's 500. Now your new interest charge is 7% of 500,000, so it's 35,000 instead of 28,000. But with these new accruing kind of interest rules, basically that interest would just be on the 400K, not the 400 plus 100. So your interest would be 28,000. So you would divide 28,000 by the balance you owe of 500, and then that would be your actual interest rate, which would be like 5.6 instead of 7. But what's weird is as you pay down your accrued interest balance, your interest rate actually grows up to the level of your statutory interest rate, your 7% that you borrowed at. And the reason is because, as you're paying down that accrued interest balance, the total interest divided by your denominator is larger. And then when all that accrued interest is paid off, then your interest rate is just the federal interest rate and that's it. So this is not going to really change people's refinancing strategies for student loans. I don't really think at a big level. It doesn't also impact any capitalization that's already occurred either. But what this does is it kind of complicates the advice a little bit. Somebody who's newly out of dental school, they actually might sign up for like revised pay as you earn, become a practice owner, then maybe pay down some of their accrued interest to get that effective rate actually a little bit higher to justify refinancing. So in other words, you're kind of keeping in the security of the federal loans because the actual interest rate is not quite as high because it's simple interest instead of compounded interest. And then you would have to refinance once you pay down at least some portion of the accrued interest. So this is obviously getting more complicated, not less complicated. All these policy changes are intended to help borrowers, and they do. They give us advice givers in the student loan world more tools in which to save people money. But is it better for people? Yes, I guess, but it's also more complicated. So I think that's something to just really be aware of with what they're doing here. Now, the interest capitalization events that are going away, it's virtually all of them except when you leave income-based repayment. So when you leave income-based repayment, by statute, they're required to capitalize your interest. So basically everything else, they are making it so that you don't have to capitalize your interest. So that change again is for July 1st, 2023 and after. not before. And what we usually find is interest capitalization is pretty meaningless if you're going for forgiveness. So please keep that in mind. This is really only something that people that are going for refinancing should really care about, because if you're going for forgiveness, I mean, who cares if you're going for PSLF if your interest balance is an extra 50,000 or not? You're going for PSLF anyway, so it doesn't really make one bit of difference. So just keep in mind contextually what matters and what doesn't, and what saves you money and what doesn't.